What's good, guys? So I just wanted to quickly come on and show you guys the calculator that I created and that I use in order to do the calculations for the business acquisitions that we're looking to get into. So this is a very surface level baseline. It's designed to be very quick, efficient calculator that you can just input a few numbers and all the formulas and everything is already inputted in order to give yourself a quick yes or no to certain business acquisitions. Now, we're looking at business acquisitions in a way where majorly using debt and bank loans in order to acquire businesses in order not to give up equity in the businesses themselves. So this is a calculator where you can put in certain numbers, being the main numbers being asking price, revenue, and the underlying profit, annual profit a year of the business, and it will tell you the debt service coverage ratio, DSCR, which is probably the most important factor and value that you'll need to determine whenever you're looking to acquire businesses. What a DSCR is basically a ratio. It tells you how many times over does the profit cover the debt service. So, for example, say you bought a $1 million business, you paid $1 million for it. And just for easy numbers, say it was you had to pay $10,000 a month, but the business itself makes $20,000 a month. That would mean that you would have a 2.0 or 2 times or 200% debt service coverage ratio, DSCR. So that's basically what it is. Ideally, banks want to see something above a 1.25, but especially when you're starting out with businesses, you definitely want your first business to be something that is a bit of a higher number, because that gives you a bit of a safety net. So I look for something between 1.5, but preferably above 2, like the example that I just gave. So just to run through the template, just real quick and easy. So you're going to start off with the asking price, the revenue, and the EBITDA. From the revenue and the EBITDA, it will give you the margin. You want something around above 20%. So say the business has $100,000 a year in revenue that it's making. Ideally, you want it to be making $20,000 profit, and then extrapolate that into millions, etc. Okay, and then you can come down to the true EBITDA. So this is the EBITDA that would be present in the business after you pay yourself a salary. Now, when you're starting out, maybe you're looking for businesses that are 500K asking price, maybe the profit's 400K a year. You probably wouldn't pay yourself 100K per year from that one business, maybe 50K. But you just got to remember, say you bought maybe 5 small businesses and you paid yourself 50K each from all of them. That's 250K a year that you're taking home in your pocket, that you're getting paid for, potentially just for managing the business. But just remember, the main goal when it comes to business acquisitions is that you're going to be buying up a bunch of businesses, rolling them up, as they say, creating a platform, and then to eventually sell. And then that's when you make the big cash back. But in the meantime, you can pay yourself a bit of a salary, or you don't have to, because that would raise the debt service coverage ratio, the DSCR. But yeah, you ideally do want to pay yourself a little bit of a salary, just because, we do want to make money in the meantime while we're rolling up these businesses, for anywhere from 7 or maybe even 5 to 10 years, right? So that's the true EBITDA. And then this value here will just give you the EBITDA multiple that they're asking for. So that would be the asking price divided by the EBITDA. And if you don't know, that's normally how you value a business. It's just however many times over the EBITDA. So say a business does 200K in profit a year, or EBITDA per year, and you want to buy it for a multiple of 2. So 200K times 2, 400K is the asking price for that business. And the bigger the business is, usually the more multiples it goes up by. So say it does $2 million EBITDA per year, that might be a 10x EBITDA to buy that. So 2 times 10, $20 million asking price, right? And that's the whole game when it comes to business acquisitions. It's a EBITDA multiple play. So you're buying a bunch of businesses at a small EBITDA multiple because it's just one singular business. And then when you roll them all up and there's 10 businesses in one big platform, now you can sell that one big platform for 20 times. Maybe that's a bit much. Maybe 10 to 12 time EBITDA, right? Okay. So it'll give you the EBITDA that they're asking for. So say they wanted a 3 6.5 times EBITDA multiple, and then it will give you the number of the valuation that we want, and you can change this right here from the 3x to whatever you want, and it'll give you the number for that, and then it will go by that number for the rest of it. And you come down to all the actual bank debt. So say you can get 90% of the asking price covered by the bank. You put it will give you what that amount would be of the total asking price, right? And then you have the 90, 80, 50 that correlates with that. And then also 100% if you're able to get 100% like the bank that I'm going to be using, that I've already talked to and done all the discussions with, as well as if you want a bit of a seller finance portion, which, go research for yourself what seller finance is, what seller rollover equity is. These are just different ways that you can structure a deal so the majority of the asking price doesn't have to come from a bank. It can be financed by the seller himself or herself. It can be you can only buy 80% of the business maybe, and they keep 20%, so that'll be seller rollover equity, right? So there's other ways. So if you have a portion bank debt and then a portion seller finance debt, it will combine that to give you a combined DSCR. So you would just put the numbers here that you would get from a business loan calculator. An example I have here is ANZ's calculator. So you put in, say, the asking price was $1 million, but you wanted to borrow 800K. You'd put that there, maybe at an interest rate of 8%. You're going to pay it over 5 years, and it'll tell you the monthly, right? So you would take that number, and you'd go ahead and say if it was for the 100%, you'd put it there. And then it'll tell you there's no numbers in up here. So it doesn't give you the DSCR there, but that's just the example for it. And then just for presentation's sake, over here, you can just have what's the total purchase price that you want, and you put the bank debt that you would want to get from that. Maybe if it's 100%, you put 100% there. But you do want seller rollover equity and vendor finance or seller finance because that actually incentivizes the seller to make sure that the business does well after you acquire it. So they still have a piece of the pie, which is preferable, right? And then it'll tell you the total result there. So that's basically what it is. I left a little bit of space just to give a couple of notes on it, and just gave a bit of notes here of what you'd want to see with a number to the left of that. So, that's just a brief breakdown of the calculator that I use. Do with this what you will. If you want a copy of this, I definitely can supply that. Just comment that in the comment section. Like, subscribe. I'm going to make a few more videos about this, just giving the knowledge that I know about business acquisitions of what I've done so far. Been doing it for around 6-7 months, 6-7, whatever. And right now we're in the process of putting in my first LOI for my first business acquisition. But I've looked at many right now. I've talked to all the parties that you can think of: banks, accountants, lawyers, business brokers, investors, everything, investing firms or investor firms. So yeah, this is just a short little video to give you this calculation. So do with it what you will. I hope it was helpful. And peace.